Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Thematically, not much has changed from last week's episode in the sense that the S&P and NASDAQ continue to edge higher to new record levels that we saw yesterday. Bulls are pretty happy, but getting a little more cautious. Bears are telling the same story that they've been saying all year. And from our perspective, we've been long all but about 1.25% of this year's rally and keep moving up trailing stops underneath so we don't fall prey to the bears that the world is going to fall apart scenario. If it did, we'd simply just reduce our longs and still having made significant gains compared to those who simply refuse to be in it at all. And what I am really seeing is a rather dramatic barbell approach to the market right now. In other words, you have very confirmed bears, most of which have been bears the entire year, and you have confirmed bulls, and you don't have a lot of people in between. And generally, all markets have some type of gray area, but we're not seeing a lot of people kind of caught in between. We have those who have invested and stayed with their long exposure and added to their long exposure. And we have those who have basically been saying that the world's going to fall apart, that the economics don't in any way match the rally that we've seen since the Christmas low of 2018. And for the most part, have missed the entire move. I can think of one person, of course, I won't use their name, but I can think of somebody who is consistently putting up almost daily, let's say, information and posts on LinkedIn, who's an economist, or at least considers themselves an economist, and keeps putting out information about how bad the world is, how bad the economy is, and that things are going to, drop precipitously, and pretty much like, he's already implied, like, if you don't listen to what I say, you will pay the price. And I've commented to this person through LinkedIn simply in the sense of saying that missing this whole year's rally, purely based on your economic thought that somewhere down the road the U.S. is going to go into recession, you may be right. But you've missed 300 or 400 S&P points rally along the way, just simply because you're arguing for the case that down the road, the bounce we've seen won't hold up. And I don't know if it will or won't, but I'm certainly not going to pass up multi-hundreds of point S&P moves higher on what may come in the future when the market's ripping to the upside. And you're still holding on to less falls decline as the real story in the market. And I think of it in terms of, well, given the comeback to new all-time highs that took less than 4 months to occur in 2019, I'll definitely edge more on the side of being bullish was correct, and that being bearish might be correct sometime in the future. But certainly hasn't been correct yet. And even if you got a day where the S&P fell 100 points now, and that's kind of equivalent to the Dow falling 1,000 points in a day, so it's significant. That's in the neighborhoods of 4%, give or take. You've still missed a whole bunch of this year's move. So for those who are super bearish and have been, and that's different than first getting bearish, let's say here near all-time highs, I'd say you really missed the boat. And it's the difference between kind of being in the markets for what the market gives you at any given time versus trying to use pure economic theory to determine what the market will do. I think the market has proven, at least to this point in the year, and today's April 30th, so it's the end of the month, and the end of the first third of the year, clearly you wanted to be long and to stay long. And you can be cautiously long, but that's the way to have made money, at least till this point. So what I want to do today is let's take a look at the S&P chart should take a look at what it's showing us, both as far as potential upside targets that we can see as we're pretty much sitting on all-time highs. And right now the S&P is off, I don't know, 7 points or so. So we're starting the day with a little weakness, but we're sitting just I don't know, 5 S&P points away from what had previously been the all-time high from last fall. And then beyond looking at the S&P for both upside targets as well as downside kind of important support levels and a stop level underneath there, let's also take a look at some key stocks in the consumer discretionary sector. The reason I picked that is it's been obvious that that technology has led the market so far this year. It's been the clear winner all the way through the year. But consumer discretionary names are definitely showing some new upside relative strength trend. It's another sector to be overweight and certainly looking at for those of you who play individual names and are looking for pockets of within the sectors where can I still pick up some alpha and get some outperformance. So I think the consumer discretionary sector is that secondary place you want to be focused on. So we'll take a look at some key names there in the time we have. So let's switch now to our charts, and we're going to start off here. And this is a weekly chart of the S&P 500. And you can see we've just barely broke into new highs above where were last fall's highs. And in theory, there is some resistance here. After all-time highs that led to a significant decline of 20% that's come all the way back should pose some resistance. But as I've told in the No Trader clients, as well as my institutional clients, and again, just as a reminder, in the No Trader is the report I put out for individual investors. I think there's still some more room to go on the upside. And if you take a look at this chart, the circled blue area where it says next target on the right-hand side of our chart that I'm kind of highlighting with my mouse now is in the neighborhoods of S&P 3000. The pink dotted line that goes across just about at 3000 is called a trend factor. It's a model that is part of the suite of models that Tom DeMark developed, and it would suggest that that is the next upside target. So I do think that we will likely push through the 2940-ish level with enough oomph to carry us another 50, 60 points higher, and that would be the next target. You'll also notice that if I connect a line from the January 18th highs, which is here, let's use a nice little ellipse or something. So I'm basically saying if we take this high and connect it to what had been the all-time highs, which is this green dotted line, it gets to also, over the next month or so, just about the 3000 level. So that to me is a logical next side target. Doesn't mean things have to end there, but that's at least what I think will likely occur from where we are now, and that the market will not have a significant decline from this 2940 level, which had been prior all-time highs. Above 3000, we've got this level here. Again, let me go just kind of circle it. It is this teal colored line that is around 80-ish, give or take. That's the next side target, and that's from a propulsion model also that still has a signal that suggests that's a measured target to the upside. More importantly, let's also take a look at where the levels are on the downside that are important. And I've got this zone here in this kind of purple box that I think is kind of the levels we're going to want to look at, and where I would do some decent buying should we get down there. That range is anywhere from 28.25 down to just about 27.90 or so. So that represents only 1% or so range in the S&P. So that's a very kind of valid and viable amount of room to look for in order to think that that level can hold. So what takes place within there, and I think if I flip to, let me see, let's just make this a daily chart. I've got a daily TD/ST line. Again, this is part of the whole sequential model from DeMark. A lot of the models we use are within the DeMark realm. You've got the 200-day moving average actually down at 27.72, but that's, you can see, is moving higher, so that should fall into the zone in a matter of days. And also you'll recall that the old highs were around 28.15, all right? So these, if I draw a trend line, kind of roughly shooting across here, that's approximately 28.15, so that falls into the range. And just over the last day or two, I'm noticing actually that the daily propulsion level has moved up to 28.32. So I'm going to say the level probably of most significant support really encompasses this level too, and starts at this level. So 28.32 down to about 27.90, so a little over a percent, maybe 1.5% or so. That should be where the bulk of the support is now. And unless we get underneath that level, I am not concerned that the pullback we would see, which would still be 3 to 4%, of relative to where we are now. So it is a meaningful decline, but I'd not be concerned in the big picture of things the way the bears are, that you know, we're on the breaking point of what should be the next big move down, and that this rally has just been a false rally. And I see a lot of the economic information that people are looking at to help determine and come up with the scenario they do. And I'm not saying it's invalid, but while the market is still trending higher, and let's put up even, I want to take away a couple things that might get in the way. So here, I even want to take off the 200-day. Let's put up the Ichimoku cloud chart. Notice how much of the trend since the Christmas low, even starting in early January, has been above this magenta colored line, which is the first level of support in the cloud model. When it broke underneath in March, it basically, you had only 1 day's close underneath this orange line, which is the baseline. We came back, made new highs. You pulled back to the orange colored line again, and have been climbing up this pink line. So, you know, if you're an aggressive bull, buying against this magenta colored line has worked very well for the bulk of the year. If you're a little more concerned that we could still see, you know, somewhat of a decline, you wait for a pullback to the orange line, which is at about 28.67 as of today. And then if you want to really save your powder for bigger buying, again, now it would be anywhere from about 28.32 down to, let's even say it could be 27.99 or so. May not even need to go as low as 27.90. So that's the zone I would really expect the bulk of support to come into. So we've laid out both upside targets and downside, kind of the really important support level as far as I see it. I'm less concerned if we were to just draw a simple trend line from the Christmas low. It's going to be a pretty sharp angled line. And in fact, okay, so that's broken. That's broken. There really is no trend line that you can draw off the lows that would still show the uptrend. And that's because of the fairly steep quality of this line. That doesn't mean if this breaks, that doesn't mean to me that everything is going to fall apart. It just simply doesn't. I think that if we look in terms of, you know, where the old highs were, and the fact that we're hanging out here, we haven't broken through them enough to do, yes, in official factual terms, we've moved above the all-time highs, but we haven't seen enough strength through that, the 29 of 41 level, or what had been the all-time high close, which I think was 29.29. we haven't seen enough push through there to definitively say we've had a breakout from there. But my guess is that this level, considering how much the market came back, that what were all-time highs are not going to be a significant resistance level now. I think 2812-ish was more important a level, and having broken through that suggests that we're going higher. So if I go back to the weekly chart and blow this up so you can easily see, this blue colored or teal colored level here at 2812 to me was really the more important level, and having pushed through it at least gives me some sense that all-time highs are probably not going to present a major hurdle point. We could spend a little time here, but as I say, I think the next target that makes sense is much closer to 3,000. So that's what I'm seeing in the S&P, and I think you get a pretty good sense for me about the difference between the big macro thinkers who will keep hounding the bear story simply based upon this down move here, which changed their whole tune and therefore had them miss the entire move since. So that's that. Now let's take a look at, I want to look at some consumer discretionary names. Again, I say this is a sector that is showing good trend as far as relative performance. It's got momentum. It's building momentum. It's outperformed. So let's take a look here at what the charts show. So consumer discretionary has not made new all-time highs. Going back to this actually peaked out last August. Notice that the bottom was made on multiple important things in the charts that I look at, which include the DeMarc's TDST line, which is this dotted line, which showed up at 1415, saying there's medium-term support there. A weekly 9 setup count, which is 9 consecutive weeks that the close is less than the close from 4 weeks prior, which is often a turning point, especially in a bull market. It's getting a 9 down is much closer to a real bottom, most likely. And then the cloud, which is, again, the Ichimoku chart. The last time that the consumer discretionary ETF XLY, I'm sorry, this is Amazon. The last time Amazon got down to the cloud was back in 2016, and it bottomed almost on the same type of way of bottoming against this horizontal TDST line right against the cloud. What this had also going for it was a 9 count. Again, this is all part of the sequential model that DeMarc has. So the bottom was fairly easy to as bad as sometimes the world looks, you know that you've got to buy it when everybody's telling you everything's horrible. And that was the case here back in December. It has come very nicely back near and testing not far from all-time highs. We have now put in the same 9-week pattern in the opposite direction, 9 consecutive Fridays at the close is above the close from 4 Fridays prior. That is going to be a temporary stall. And if I look at not just the all-time high, but the close of the week of the all-time high, you'll notice here, and again, I'll kind of push this on that bar, 1952 was the close of the week that made the all-time high. Last week's high, 1960. I'm sorry, 1950. So we got 2 points away, which we managed to get to this week. So we've tested the closing price from the day that made the all-time high. Tom DeMar calls that the TD magnet price. So I would not be putting new capital to work right here, right now in Amazon. I think it can pull back. I potentially look for this, again, kind of magenta colored line, which will move higher over the next few weeks to be first level of support. So I am a happier buyer, probably closer to 1,800 or so than the current price of where Amazon is. Let's take a look at Ford. Ford certainly was in the news this week. And here's the weekly chart of Ford. So Ford obviously had long-term double top, 2011 highs were up near 19, 2014 highs were up near 18. It was accompanied by a 13 and a 9, both potentially suggesting exhaustion of upside. And then what's important is that recently we've got a counter move or counter signal. This 13 on the downside is a sequential buy signal, or at least it would be determined like, instead of calling it a buy signal, let's say, I'll put it in the terms that DeMark himself would phrase this, it's a really bad time to be a seller in a declining market. You know, a lot of people say, okay, if it's a bad time to be a seller, it's probably a good time to be a buyer. That doesn't necessarily mean it's the case. There are times that 13 signals simply change a trend that's been moving down to go sideways. It doesn't necessarily mean it's going to turn around, but in this case it did. So it was a good downside exhaustion signal. Ford has moved up nicely into cloud resistance. It is above the first propulsion level, and as long as we hold above the propulsion level, then I target 1167 and ultimately 1281 or so as next upside targets. So I kind of like Ford. I'm a buyer in a pullback. Anything near 9.5, give or take in that range, is probably a level that I would consider putting on some longs. And so any weakness here, I think you want to go after on the long side. Take a look at Home Depot. Again, all these charts are weekly charts. Notice back in 2015 here, let's see if we go to 2014. These were highs at the time. Cloud support led to new highs. The sell-off in 2015 came right to the cloud, turned around new highs. Pullback in 2016 into the cloud, held as support, new highs. And then in December, the market actually, Home Depot actually breaks underneath the cloud, the bottom of the cloud, for the first time in the up move, but its lagging line, which is this blue line, which represents here. Let's blow this up a bit so you can really understand. The lagging line in the cloud model is nothing more than current price displayed 26 bars back in time. In this case, it's a weekly chart, so it's displaying current price back 26 weeks. If it was a daily chart, it would be 26 days. If it was a quarterly chart, it would be 26 quarters. So it takes current price and pushes back 26 bars in the time frame that you're looking at. We are looking at a weekly chart. What's important about it is that when price broke underneath its cloud for the first time in years, which puts you into a major cautionary mode, the lagging line held against the bottom of the cloud. So the lowest close in 2018 on a weekly basis, which was the week just before Christmas, that close is represented by this close right here on the lagging line against the bottom of its cloud. It's actually, from a pure trading point of view, the best time to put on a buy. And why would something that looks like it's about to turn into a full-scale sale be a good low-risk buy? And the answer is because if this made any more significant decline, Home Depot would have gone into a medium-term sell mode, which means that if you bought it here right around 160, you probably didn't have to risk much more than $5 on the trade. So if you're wrong, you lose $5. And why would you get out? Well, because if it closed down here, then the blue line would have broken beneath the cloud. The current price action at the time had broken underneath the cloud. You'd be in full-scale sell mode. Reality is that because this held where it needed to, it was the last chance for bulls in this time frame to be able to bid into support with a very tight stop. There's very few times that you can bid and have such a tight stop than when the cloud's lagging line hits the bottom of the cloud. So I'm not saying you knew to do this or that you would have done it, but if you had seen it at the time, this, from a trading perspective, is a very low risk trade. And if you had put it on at 160, I would say that you probably would have exited when price action got back to the top of the cloud and at about 195. And you would have been out, and it would have been a heck of a trade that in 2 months or so, you took out, what's $30 or so. Meanwhile, in the bigger picture, we still haven't taken out all-time highs. There's a little pressure this week. Notice again that we topped out not against the all-time high, which is up here at 215, but look at the close of the week we made the all-time high. That was at 209. Last week's high, 208 and change. So you can see that often it's the closing price of the extreme price bar that ends up being more important than the actual high or low. Same type thing here. Let's say, just for educational purposes, that Home Depot pulled back and got a decent decline. You've got the low down here at 168 that most people are going to look at as being really important. I'm going to look at the close also. So not only will I know 168 is an important level, I'm going to look at the close of the week that made the lowest low. That close was 170. That's right up in here. Notice that 170 level is darn close to where the next trend started to the upside, which was 168. So now I know 170 to 168 is really the important support in Home Depot should it get a pullback. So again, I look at charts a little bit differently than most people. I tend to, these models are institutionally based models. Very few people in the public will pay the cost to have access to these models, these DeMark models. I've been using them for, must be close to, well, it's definitely over 20 years. It's probably about 24, almost 25 years. And so this is all part of the repertoire that I look at. Let's take a look at calls. Calls has come back from the 2015 high, made just about equal highs. Early part of 2018 made push to new highs. Notice the new highs were accompanied with an upside exhaustion signal, this 13 signal right here. We sell off. Where do we hold? Bottom of the cloud, propulsion target level. And we've come back, and it's having trouble coming out of the top of the cloud. Plus, it has a weekly 9 count. It also says to me right here, right now, I probably don't want to be a buyer. I rather buy on weakness. Perhaps it gets, if we got it down to 64 or so, I'd be a buyer down there. If I'm long the name, I may consider selling upside calls or so. And until this, I probably want to see it break out. Well, here, let's even look. Here's the highest high. Where's the close of the highest high? 72 and change. Last week's high, 75. They've intersected. So it really did stall against resistance. And I'd wait for it to get above there before I then further target these levels up here at 83 and 87. So that gives you a little taste of this consumer discretionary name sector that's been, again, gaining good trend, let's say good relative trend performance. Just had to contact me, Rick, at intheknowtrader.com. And of course, check out our website and what the weekly report that we have for clients at intheknowtrader.com.